Option is also one of the standardized derivative instrument which has some kind of security that is offered through regularized stock exchanges. And in case of option, the basic nature, as we say, no, it is you have an option to the option holder has an option to buy or maybe postpone the buying or cancel the transaction as the case in a general option contract. Okay, but there are variations to these conditions based on the type of option, but generally there is an option that is given to the buyer or the holder with respect to the transaction. Okay, now before we discuss with the accounting concepts, you really have to understand two things. One is about premium, another one is option strike price. Okay, when the option holder, the option buyer or holder is about to enter into a trade, into a contract, he has to pay something called as premium, which is the cost of the option, or it is actually the cost of that right to buy or sell the underlying asset at the option strike price. So when he is entering, when the buyer of a particular option, that option can be for buying or selling. Okay, when he is going to buy that, when the buyer or the holder is going to do it, he has to make up pay a premium, a price called as premium, which is the cost of the option. That is, their buy the right, the cost of the option for buying the right to buy or sell the underlying asset at an options strike price. Now, the second thing you might be wanting to ask me is, if that is the case, what is strike price? It is actually, strike price is the exercise price, or the price at which the option contract is actually exercised. You buy it, you buy the contract for a future date. On future, at what price you're actually buying or selling the option, that particular option, based on the value of the underlying asset, that's what we call as an exercise price. Now, you really have to understand the difference between a premium and an exercise or strike price, because this can be asked for university examination also. But above that, you have to understand it if you really have to understand the accounting aspect. Okay. So an option buyer, in order to buy the contract, when he pays an amount, that is called as the premium, and the strike price or exercise price is the price at which the transaction or the contract is exercised on due date. It can be buying, it can be selling based on the type of contract, and also the value, the exercise price depends upon the value of the underlying asset. And that is why a strike price is the set price at which a derivative contract can be bought or sold when it is exercised. I enter into a contract, I get the right for that contract by paying premium, but that is going to happen on a future date. I have an option as an instrument, and the value of that is decided by the underlying asset. To get that option, to get that, or to have some kind of right to that contract, I pay the premium. And then that is to be done by the buyer, the holder of that contract. That is to be done by the buyer or the holder. And at what price it is exercised in future will be my strike price or exercise price. This is the understanding, general understanding, which you have to have when you are going with discussion about the accounting aspects of option trading. Now, as we had discussed about futures, there are many similarities. Here also, accounting during the inception is, there is the seller or the writer. The seller is otherwise called as the writer of the option contract, has to pay an initial margin. This margin is to be kept with the stock market. Okay, and it is debited to equity index option margin account if it is the underlying asset is index option. And if it is the underlying asset is stock, then it will be called as equity stock option or margin account with respect to margin. So the seller or the writer would be paying a margin to the stock market, and the buyer is required to pay a premium. And this premium is debited to the equity index option premium account of the seller or the writer. Okay, because he is going to pay this to the premium, this premium to the seller of or writer. So that will be put under the buyer, the holder is required to pay premium, and it is debited to the equity index option premium account, okay, of the buyer and the holder. And in the book of the seller or the writer, the premium is credited to the equity index. If it is equity index option premium account, that it will be credited to the equity index premium option account. So there are two transactions that can happen at the time of inception. One is payment of margin by the seller or the writer, and another one is payment of premium by the buyer or the holder. And this premium is paid to the seller, and the margin is deposited with the stock market as a security against conduct of this contract or observance of the terms of this contract, right? So that is the first one, accounting during inception. Now the second one is accounting for open position. Suppose if I'm going with the close of a financial year and there are many option contracts which are yet to be settled. Maybe the contract date is in future, so it is yet to be settled. So in that case, what happens here is if the option holder, okay, if the buyer is expecting a loss, then definitely provision to be made for that amount, which we say that it is in excess of the premium. Okay, so he needs to make a provision in his P&L just to anticipate and provide precautionary measure for the possible losses. If the amount is above what is already being paid, and in the book of the seller, if the provision to be made for the amount by which premium received for the option exceeds the premium prevailing on the balance sheet. See, generally what happens here is with respect to losses, and of course this the amount received by the seller would be a current liability, and the amount paid by the buyer would be a current asset. It will be appearing under the head of current assets, loans and advances for the buyer or holder, as we said in case of future. And in case of the seller, since the seller has taken the money in advance from the buyer and the asset is yet to be transferred on the exercise date, it will appear as a liability in the balance sheet. Now, if the premium amount is the liability actually shown in the balance sheet is lesser than the premium amount paid by the buyer, then that needs to be additionally shown. That amount which is exceeding the excess amount paid by the buyer or the holder than what is shown in the balance sheet should be added, because that's additional liability. So that's what being done at the time of open position. So there are two things which you have to remember. If the provision for premium paid is shown less, that needs to be actually the position needs to be reflective of what being paid under premium. So that is why if the premium paid by the buyer is shown at a lesser amount in the balance sheet, that needs to be increased to that amount, because he has already paid money. Say for example, balance sheet is showing 5,000, but actual money paid by the buyer or the holder is 10,000. Then that amount needs to be added to the particular head in your balance sheet, as well as the provision to be made in your P&L. Same as the case in case of seller, if he has received 5,000, but the amount in the balance sheet is just 2,000, then the seller needs to show the total amount received from the buyer as premium in the balance sheet, as well as the adjustments to be made in the profit and loss account. That's all when we are talking about the open position. And then accounting at the time of final settlement, basically the losses. Okay, if you have a loss, it will be shown on the profit and loss account. It will be adjusted in the profit and loss account. And if you already have a provision, automatically that adjustment will be made against the provision. And if you have incurred profit, that also will be added to the your profit and loss account. Now I have put on exercise of the option, the buyer, the holder will debit the profit and loss account and credit the equity index option margin account, because in that case, it's just the opposite. You are cancelling. You have to cancel, because when you were paying the margin, you had debited the margin account. Now, when you are cancelling that, during the final settlement, the final amount needs to be cancelled. The margin money, the difference needs to be cancelled and the transaction is closed. So you will be crediting the equity index option margin account and debiting the profit and loss account, because money is being paid back, right? So you have to cancel that account. The same as the case will happen with the premium also. You have to cancel the account based on the difference. And the difference between paid and received is transferred to P&L account. This is with respect to if the same person is having both option to buy as well as option to sell. He is having the position as a buyer or a holder as well as a seller or writer. Say in some option contract, he might be the buyer. He has bought it. But in some cases, maybe he bought it and then he again engaged into another transaction where he is selling that option. So in that case, he's the seller. In the first case, is the buyer and the holder. Second case, he is the seller and the writer. In both these cases, finally, when you are arriving at the settlement, you will see what is the profit you have gained as your position as a buyer, what is the profit you have earned as your position as a seller, and this will be settled to arrive at your final profit or loss as an individual trader. So that's what we call as the difference between premium paid and received, because when you're acting as a buyer, you will have to pay the premium, and when you are acting as a seller, you will receive the premium. So the difference between that is set and it is transferred to your profit and loss account. Suppose if it is a charge, it will be deducted. If the amount is excess, it will be shown on the credit side of your profit and loss account to adjust the balance so that it will be reflected in your balance sheet. So I repeat, when you are closing the index, the premium index account, the margin account, everything needs to be cancelled. The opposite entry will be passed because you're cancelling. Once you are debited the margin account, now you're going to credit it by debiting your profit and loss account, because the amount will be transferred. If any excess amount, it is transferred to your profit and loss account. And one thing which you have to remember is final amount, only the actual amount, final after settlement of all the transactions will be transferred to the trader's account. So in certain cases, he might incur loss. In that case, he might have to pay additional in order to settle the transactions, right? So these are accounting for option. Only difference which is the premium amount that will be paid by the buyer at the time of entering into a transaction. Then we also discussed about a strike price and an strike price or exercise price and a premium. Premium is the amount paid for getting the right of an option contract, and the actual amount paid during the exercising, actual conduct of the contract, actual exercising of the option is what we call a strike price or exercise price. Maybe say, for example, I bought the right of 3-month option in the month of May. I bought today, and then I'm going to exercise the same after 3 months. So it will be August. Right, so I'm going to exercise that. Maybe May, if I consider May is 1 month, and then June, July. I am going to exercise that in either at the beginning of August or maybe at the end of July. Right. So in that case, the price at which I'm going to exercise that, I'm going to conduct the transaction will be my strike price. Now to buy that, I have paid the premium. To get the holding or to become the holder, I have paid the what I call as the premium. So this is all about accounting for option. And then the next thing what we have to understand here is, prior to 2005, all the transactions which were happening in the derivative markets, they were called as speculation. Okay, they were called as a speculative transactions. But by the Amendment of Finance Act in 2005, in order to promote more transactions happening through a regularized market, stock market, the Act was amended to include that those transactions that are happening to regularized stock market, stock exchanges, will not be brought under the head of speculative income or loss, which means it is not taxable under speculative profit. It will be brought under the income gained from the other sources, other income from your income from other investments. And suppose if in a particular financial year you do not earn a profit or you do not have you have not earned any income other than no, what I'm saying is, if you have incurred a loss, then that can be set off against the income from other sources. Maybe because you're a beginner to a derivative transaction, you have incurred a loss. That loss can be set off against the income from other sources, okay, from other heads, which you can also set off against the losses for the next, I mean, the loss can be set off against the income for the subsequent 8 years. For the next 8 years, suppose if I've incurred a huge loss because of entering into a derivative transaction, I can set off that against my profit for the next 8 years. And securities transaction tax, STT, securities transaction tax, which you have paid when you are engaging in derivative transaction, is equally considerable as a deduction in your when we are going with income tax. Filing of income tax, that can be claimed as a deduction. STT, that is securities transaction tax. These are the tax aspects. So prior to 2005, all the income which you earn, whether it is from a forward transaction, whether future, whether option or any other, it will be brought under speculative transaction, speculative income, and it was charged under that. But from 2005, the Finance Act was amended to say that under 43 subsection 5, it was amended to include that those derivative transactions which are happening in a regular stock exchanges will not be regarded as speculation, and the income you earn from that, from such transactions, is not considered as a speculative income. So definitely you can show that when you are filing the return, income from other sources. And if you have incurred a huge loss, you can also set off that against the other heads for the subsequent. If you have not earned income from other sources the current financial year, right, in the current assessment year, then you can take it to the next years till for the 8th year, till you can set off it until the 8th year. So that's what the taxation of derivative transaction. And of course, security transaction tax, STT, which you pay as part of your derivative transactions, is possible to be deducted, is considered as a deduction by filing the income tax return.